Up, Sally. Sally, can you hear me? You're on mute. Oh,
Sorry,
Sally.
I was up. Yeah, I hear you. I was just trying to unmute. Oh, everything's a challenge these days. How is everything?
I am blessed. I'm very
Well,
busy, but I'm
yeah,
blessed.
I
How
bet
about
you
you?
are. That's good.
Yeah. So when I do the presentation, do you mind being host? And so therefore, you can let people in if they come in during the presentation
Sure. What do I need to do?
and unmute people if they want to ask a question.
Okay, yeah, I can do that now. Okay, so just kind of give me a tutorial really quick.
All right. So I'm making you host right now.
Okay. Yay.
Did you get a message?
Yes.
All right. So when people come into the waiting room, you'll be able to admit them,
Okay.
and
Like that.
you'll be able to put people on mute or ask people to unmute.
Oh, okay. So that was the AI asking for admission.
Yeah.
Okay.
And you know what? And I typically start actually doing the presentation about 5 minutes after 5 or 5 minutes after the hour.
Okay.
And we only had a couple of people that signed up this week. I didn't
Okay.
I didn't have the chance to do extensive um, social media marketing this week.
Uh-huh.
So I got to automate that. Um, so I'm still working on that.
Okay. I'm just you didn't send the link to the email address, did you?
No, see,
Okay.
that's what I'm talking about. I didn't send an email out. I did a link or a post today on LinkedIn and on Facebook. Facebook actually blocked me and restricted my access for 24 hours. I,
Why?
Um, I guess I was trying to add too many people, trying to tag too many people, or actually tagging the wrong person. Um,
Um,
yeah, and I don't know who that person was. They just gave me like a ID number, but I couldn't find it, right? Because I was tagging some celebrities. So
okay. Mm-hmm.
pretty sure that got me flagged for 24 hours. So
Mm.
um
It's saying here with this AI note taker, allow recording to apply these permissions to all future requests in this meeting. I would say no or yes.
yeah, you can go ahead and let it record. I don't care.
Okay.
So I think this AI bot has been in here before.
Oh, okay.
So no, each webinar is a little different according to the participants, um, whether they've been in a prior webinar or whether they have um, experience with out-of-state investing. So,
Okay. And so it says see apps that are accessing your meeting content. I don't know what that means.
is that a
Outer
is that a pop?
Otter, it says Otter Pilot Smart
Yeah.
AI.
That's Leon's AI note taker's audit.
Oh, okay.
So we have an opportunity to purchase several portfolios from Clarence or through Clarence, should I say.
Oh, really?
Yeah, I think one is five properties and the other one is six properties.
Oh, so what is Mr. Clarence proposing?
Well, for each one, he wants around 300,000, um, which is fine. I started doing the due diligence on the first one, right? Because we're really looking at the tenants, right? Because we're going to be
Right.
taking over tenants. And so
Right.
like there was a duplex in which the tenants had been there since March. And prior to that, there was no tenant history.
Mm-hmm.
So, those are new tenants. They're paying on time. Um, but then in the other four units, you had three that were like a month behind and one that was like a couple months behind,
Yeah.
right?
Yeah.
And 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 so in that situation, oh, and the tenant had been a couple of months behind, has always been a couple months behind.
Oh no, that doesn't sound good. Eric Hunt is waiting. I'm gonna let him in.
But
Okay. Okay.
he's connecting. Hey, Eric, how you doing? You can go ahead and unmute yourself. There you
Yeah.
go. What's up, Eric?
Hey, you doing, sir? Good to see you.
How you doing?
I'm doing well. Good to see you. How about yourself?
I'm blessed. I'm just really busy. Really
Hi,
busy.
Eric.
And Eric meets Sally.
Hi, Sally. Nice to meet you.
Nice to meet you, sir. How are you?
I'm doing well. Doing well. How about yourself?
Oh, not too bad. Okay, just for because I haven't really truly you haven't met me yet. I'm gonna take off my camera deal, I think, just for a minute. If I
Gotcha.
can find it. All right, it's in here somewhere. There it is. Let me
So
take that off. I'm a little sweaty, so I'm sorry I've been outside.
No worries at all. Good to see you in the flesh, Sally. Nice to see
There
you.
she is. Okay, nice to see you, sir.
so uh Sally is actually the CFO of the
Great.
BNIC network. She's also a project manager for the company,
Great.
um, managing actual deals. And Sally and I go back a while now. And Sally was actually the first investor in my holding company, Temple Rose
Hmm.
Holding Company. So yeah, Sally and I go back a while,
Yeah.
We go back a little bit.
just a little bit. Um, and so this is going to be a different type of webinar because 5 minutes past. It is the three of us plus the bot. Um, and so, like I was telling you, I tailor each webinar according to who's here and if they've been through the webinar before, what experience they have, and those type of things. And so, Eric, you've been through the webinar before, correct?
Yes. Yeah. That's
Yeah.
your team. Yeah.
All right. So you know the basics of out-of-state investing. You understand that. You understand why Detroit. You have any questions of why we focus exclusively on the Detroit residential market?
Not specifically why Detroit. I think that makes a lot of sense. And I know like there's plans to scale that. I think the metrics you guys are using make complete sense to me, and it's the same thing the same thing I looked into as well when starting looking at to where I might want to go out of state. I think one of my questions is more so type of like the type of deal that you prefer to do. I think during the webinar, it was mentioned like Section 8 specifically, mainly like, but I think I also heard mention of fix and flips as well as long-term holds. So just wanting to get a better understanding of where you and Sally operate within the market, within the real estate market, and if the preference is Section 8 or just better understand that portion of it.
Okay. So give you a little bit of background. In 2016, me and another partner were looking at flipping homes throughout the United States on scale.
Mm,
And so um, I developed a risk management tool called the Real Estate Deal Management System. Because we had experienced 2008, him and we made some good money before 2008.
Yeah.
And he lost $1 million house after 2008. He worked for Lehman Brothers.
Yeah.
And so him and his wife both worked for Lehman Brothers, right?
Yeah. Yeah.
And so having gone through that, I said I need to make a worst case scenario to manage the risks associated with flipping.
Mhm.
So there are two main risks when it comes to flipping houses. So the first is overestimating how much you can sell the house for. So a market may be good and great, right, going in, and you buy a property and now you're rehabbing it, and next thing you know, the market changes and now the value goes down. This is a risk that you don't control. You may be able to do a little bit of forecasting,
Sure.
but I'm from California, where flips were taking 6 to 9 months, and a lot can change in 6 to 9 months.
Mhm.
So that's market risk. Okay. And then the second risk is a lot of rehabbers underestimate how long the rehab is going to take and how much it's going to cost. Okay. And so we were like, we need to come up with ways to manage both of those risks. The rehab risk is actually a much more manageable risk because you can.
Yeah.
I use a carrot and stick approach with rehabbers, and my background. I've got 10 years in operations, or more than 10 years in operations management, working for a couple of cities, and managing multi-million-dollar contracts. So I treat rehabbers the same way when I was in the government, and there's a lot of restraint, right? And holding them accountable is the main thing. And the way you pay them is definitely another thing.
Yeah.
I said, so I can get the rehab risk under control with processes and procedures. But this market risk, oh man. And so if you want to make a lot of money flipping houses, you use other people's money, OPM.
Yep.
And in doing that, you're going to basically, unless you have a good relationship with a private money lender, you're going to be dealing with hard money lenders. Hard money lenders lend money at a higher interest rate for a shorter period of time, right? So the higher interest rate is usually low double digits, so like 10 to 15%, and the terms are usually 6 months to 12 months, right? That 12 months is like, hey, you should be able to do your thing within 1 year, and then sell the house, or if you're gonna hold it, refinance. So I said, man, what's the worst conditions that we should build this risk management system for? And so we were like, well, what if we have another 9/11? So what happened during 9/11 is all of the credit markets freezed up. Okay. You couldn't get no money. Right. And so if you got a hard money loan, that means you can't refinance. Right. If after 12 months you're still in that loan, you're gonna have to renegotiate with the hard money lender. He'll be like, sure, let's go another 12 months at 12% type of thing, right? So that was the first thing, is we can't refinance, we got to hold on to this hard money loan. The other was we have another 2008 where the market values just plummet, which means now we can't sell it at the rate that we thought we were going to in order to make money. Now we have to hold on to it and we have to rent it, which means, man, the worst case is we got this house that we rehab, we put a renter in, and we got to generate enough rent to cover the hard money loans.
Yeah.
Right.
Right.
That was the worst case scenario. And so then, me and my business partner decided, we started in was it Tulsa? I think we started buying a property in Tulsa
Oh, interesting.
in 2017, but then that didn't work. So I put it on the shelf.
Mhm.
And then in 2021, I formed an investment club called the BNIC. Whoa, the BNIC for what was the rest of it? Um, it was it was basically the same as this one, but it
Yeah.
was specifically for Detroit,
Mhm.
right? Because what I did, I was like, okay, let me do some market analysis. And so I took historical Zillow data and I looked at two things. Show me markets that are appreciating based on the last 12 months,
Yeah.
and show me markets that have high cash flow, right?
Mhm.
As determined by the rent to price ratio. Looked
Mhm.
at both of those lists on a national level from zip codes, and Detroit kept popping up on both of them. Oh, wow. Okay. That's unique, right? Like there aren't too many markets where it's appreciating and you got great cash flow. It's usually
Yeah,
one of
or the other, right?
and so dug deeper. Now I'm looking only at Detroit and I'm trying to pick out the best zip codes, picked out the 5 best zip codes, had the investment club. And at that time, I wanted to put um, modular built homes on vacant lots.
Okay.
Detroit has more than 70,000 vacant lots and boarded up homes owned by one entity, the Detroit Land Bank Authority.
Right. You mentioned that. Yeah.
Right. And so Sally was part of that investment club. And while because it was half the people in California, half the people in Detroit. We're relying on the people in Detroit who said that they were real estate experts to find the right resources
Yeah.
for this very large project from their perspective.
Mhm.
Because when I was like, hey, we're gonna do 2,000 houses, right, in the first year with modular. Y'all got all the lots, and I've got a system um, for building complex financial and operational systems. So find me a vacant lot.
Mhm.
That was the first thing. Now, I knew that if you owned a property next to a vacant lot that's owned by the Detroit Land Bank Authority, you can buy that lot for $100.
Yeah. You mentioned that. Yeah.
So, but the people in Detroit, the first question out of their mouth was, what's the budget that you have for buying the lot? That was the first question. And I looked at them. I was like, um, I don't know how y'all negotiate in Detroit, but in California, we negotiate from the bottom up, not from the top down,
Mhm.
right? Because if I tell you I got a budget for $5,000, y'all gonna go and find me a $5,000 lot, and that don't
Yeah.
help us. But that's what they did. They came back, Mike. I got a lot for $5,000, and I was like, um, are you playing on the same team?
Yeah. Yeah. Let's
Right?
try to go under that. It's not deal.
Right. Why are you trying to hustle me?
Yeah.
When I know better and you know I know better.
Mhm.
And so out of frustration, real frustration, I just went online, got into some Facebook groups that I was already in, um, found a gentleman by the name of Clarence Archibald, who's the
Mhm.
owner of Great Lakes Property Management. He was, because I just put a post out there. Hey, anybody who's next to a vacant lot owned by the Detroit Land Bank Authority, I'll do a deal with you. You buy the lot for $100. We'll provide the modular home. We'll rent it out and we'll just split the profits 50-50, right?
Nice. Okay.
I
Yeah.
just wanted to see if the modular home was going to work
Yeah.
inside Detroit. So Clarence stepped up and said, sure. And he actually went through the process of buying the vacant lot. It was like a 2 or 3 month process with the Detroit
Yeah.
Land Bank. So we met weekly for a year, every Sunday during the year of 2021, and we didn't get nowhere. I got frustrated, and so um, we dissolved that investment club.
If you don't mind me asking, what was the issue? Why did what was the issue there? Was he able to buy the lot and the modular home just never was able to materialize?
Oh,
What was the
so the
issue?
issue was COVID. So here's what happened. So the modular home, I found a modular home issued by the largest home builder in the United States, which is Sky Homes, ticker symbol SKY. You can look them up. They're a public company. They build modular homes and manufactured homes, what we call mobile homes. Okay, but they build modular homes, which are basically a regular home that's just built in the factory. It's delivered in two halves on a flatbed truck,
Yeah.
and it takes a weekend to put it down on the foundation, to button it up. At that point, the house is 80% finished. You bring in your trades to install the internal components, and that takes about 2 to 4 weeks. Then you got a new house.
Yeah.
I was like, wow. I said, what's your smallest house and your cheapest house? It was like 1,200 square feet and a 3-bedroom, 2-bath, and it was costing $80,000 in March of 2021. I was like, okay, wow. Let's see if we can make this work. And that was retail.
Yeah.
That's not buying in volume, getting that discount, right?
Yeah. And Sky Homes would they sell homes on a retail basis as well too, not just commercial.
Yes.
Oh,
Yep. They sell homes to anybody.
okay. I
Okay.
gotcha.
And so COVID hit. And COVID, and so this is a year after COVID hit. No, wait. COVID hit in 20, yeah. So this is a year after COVID hit.
Yeah, probably.
And all the supply chain now gets gooked up.
Yep.
Plus, the demand for houses from any builder went sky high.
Yeah.
But here's what happened. So originally it was $80,000. It takes 4 weeks from the time you order to the time we're ready to ship. Overnight in April, they put a $20,000 fee on top, right? A COVID fee. So now it's $100,000, but the wait time is 1 year.
Okay.
Yeah, don't forget, Mike, that also we had that issue with shipping. We had, it over there from China and wherever else. Everything just backlogged.
Right.
Yeah.
Right? And
Not
it took
only
forever.
Yeah. So not only getting the actual price that you needed, there's a $20,000 surcharge on it, but now
Right.
being there on time is also an issue too, as well. So sort of both issues on the supply chain.
Right. And I mean, and that was for everybody, because the supply chain got mucked up. And here in LA, we had 30 ships sitting in the harbor that couldn't get unloaded. Right. So yeah, and the idea of putting modular homes on scale in Detroit on vacant lots was, at least the people that we were dealing with, it was way above their head. It was way above their head, right? Because for 2,000 homes, it was going to be like an $80 million project. Okay. An $80 million project in Southern California, it may not even be, that's not even a housing tract.
Yeah, get you a couple of homes maybe. Yeah.
Okay. Right. So it's the order of magnitude. They just couldn't do it. And with me coming from California, talking about an $80 million project, their eyes got big. And I say this often, I'll back it up. Detroit is a city of hustlers because they've been downtrodden for so long, right? And I don't knock nobody's hustle, just don't hustle me.
Yeah.
Right? Everybody got to do what they got to do to make a living. I'm just not the one to get hustled. So, and then another thing happened during COVID. The renters moratorium on paying rent.
Yeah.
Okay. Nobody saw that coming.
Yeah.
Nobody ever thought there'd be a time in the United States when you as a landlord couldn't evict your tenant and not receive payment of rent.
Yeah.
That goes against the American way.
Mhm.
Right?
Yeah. Some degree, yeah.
So, man, small landlords got wiped out
Mhm.
because though there was a moratorium where your tenant doesn't have to pay, you still got to pay your mortgage.
Mhm.
There wasn't a moratorium on that.
Yeah.
And whatever reserves now that you have are being depleted. Right? And
Yeah.
I said, shit, that's another risk that we have to put into this system.
To account for, yeah.
Right? And so, all right, well, if the market falls to where we can't sell it and we can't refinance it and we got to rent it, and and who knows how long we got to hold it, we got to make sure that we rent it to a person with a government payer source.
Yeah. Government back. Yeah.
Section 8, VA, social service, whoever.
Mhm.
Now, legally, you can't say that.
Mhm.
That's discrimination.
Mhm.
Okay. But there are techniques that you can use to where you get a lot of qualified tenants so that you can pick out of the pool of qualified tenants. And if you got a Section 8 one in there, boom, that's the one you pick.
Gotcha. Okay.
So the strategy now became, all right, we're going to go into C-class neighborhoods. We're going to build B-class properties to attract and retain Class A government payer tenants. Okay. Now, I had established this relationship with Clarence because he bought the lot. We supposed to buy the modular home, but he understood that it was going to be a year and everything fell apart. But Clarence and I still had a relationship.
Yeah.
So in 2022, I rebranded just to the BNIC Network, privately owned by my holding company. And I said, you know what? I'm gonna use a different technique. Instead of just coming in with marginal homes, I'm going to come in with a more traditional method of we're going to buy distressed homes, we're going to rehab them, we're going to put tenants in them, we're going to create turnkey rental properties. Okay. And so it was easier to explain because that term already existed. Turnkey rental properties had been a thing that came out of 2008, right? Because BlackRock
Yep.
basically bought up tens of thousands of homes from that had been foreclosed on, but didn't need no rehab, but they got them pennies on the dollar and then turned around and rented them many times to the people who used to live in them.
Yeah.
Right? And so so that's what they called them, turnkey rental properties, right? And there were a handful of companies in the South and in the Midwest that were also doing this. Memphis Invest was one that was really big in Memphis.
Mhm.
There was another one in Birmingham, Alabama, whose name I can't remember.
Mhm.
And here in Southern California, oh, I can see the name of the company, but I can't recall it off the tip of my tongue. But they've been doing something like this where they take California money and they go out of state.
Yeah.
Like they got funds, or you can own an actual property, the whole 9 yards. And so um, I had experienced them. I don't know, it was like 2012 or 2013, and so I got the idea from it's Reddick. Reddick is the company.
Okay,
I
gotcha.
got the company from them because they was taking rich white money and going into these poor areas and just gentrifying. Like, okay, I understood the model. I understood the legalities via SEC. I was like, shit, I can do that. I can get black folks to do that, right? And so, so this is where our current model for investors is for $50,000, we will build you a turnkey rental property with a renter in it. Takes about 3 to 6 months. Clarence Archibald and his company, Great Lakes Property Management, are our feet on the ground. They are a full service real estate company. They've been doing this since 06. So they went through 08. Okay. They have over 300 properties under management in their portfolio, and they manage mainly for out-of-state investors. Right. And all they do is find distressed properties, rehab them, put a tenant in it. And they do that for their clients.
Gotcha.
I was like, okay, I can take my system and lay it on top of Clarence's system, right? Because his sweet spot was $50,000.
Yeah.
And the numbers were like crazy, right? So for $50,000, I can get you $7,500 a year in net operating income. That's a 15% cap rate.
Yeah.
Okay. So in Southern California, traditionally we use residential will get a 3 to 4% cap rate. When we took the little dip about a year and a half ago, it went to like 5%. And investors was happy, right? And so I'm just saying, hey, if you're getting 5%, I can take your money and go into Detroit and I get you 15% if you just hold them. But why hold them when we can flip them? And so this is where the flipping part comes. Because if you've got a performing turnkey rental property that's generating $7,500 a year in net operating income,
yeah,
why not sell it to somebody that's looking for a 10% cap rate? Right? So at a 10% cap rate, you can sell it for $75,000. If you're in for 50 and we sell it for 75, just made $25,000. That's a 50% cash on cash return before our profit split. And so, and the way that our profit split works is we give you what's called a preferred 10% return, which means you're going to get 100% of the profit up to 10% of your investment. So you invest $50,000, you're going to get the first 5,000. So out of 25,000, you get the first 5. The remaining 20, we now split 50-50. So you get another 10, we get 10. Now you got 15. $15,000 on your $50,000 is a 30% cash on cash return over around a 6-month period. And then what we tell people is take that 15,000, set it aside, take another 50,000, and let's do it again to create another $15,000 in another 6 months. Right? So, which means off of the same $50,000, you can create $30,000 in that year. 60% cash on cash return.
And is the $50,000 invested, is the way that Great Lakes Property Management doing that from, they're not doing modular, they're just finding like distressed properties regardless, however they can get them for 50,000 and then flipping and putting selling.
So here's how the mechanics of it work. Between us and Great Lakes, we find distressed properties. And then the properties that we find, we put through our real estate deal management system.
Gotcha.
And I'm going to show you what it looks like real quick. Hold on. Share my screen. All right. Are you able to see my screen?
Yes.
All right. So this is the real estate deal management system. And every place where you see a yellow cell is an input cell.
Yep, makes sense.
All right. And so when we have a client the client gets assigned to a project manager. So in this example, let's say the client is assigned to Sally. Sally then has access to hundreds of properties on a daily basis between the wholesalers that contact us as well as the MLS.
Mhm.
And so we're able to put properties through here, and we work with Great Lakes Property Management to say, hey, this is the property address, and we operate mainly in 5 zip codes. 5 zip codes that have historically, when I say historically, I mean within the last couple of months, shown that in the last year, they are appreciating at double-digit annual rates.
Mhm.
Okay. And I'll show you what that looks like also.
Are you just like scraping data from Zillow, Redfin? There's like an API plugin to pull some of the rates,
Yeah.
or
So with Zero, there's no scraping. There's a direct connection where you just download.
oh, yes, okay.
Yeah. And so, for example, um, this is the result of us looking in on Detroit and looking at what, yeah, let me, hold on, so you can see this. This over here is the rent to price ratio
Yep.
for these months, right?
Mhm.
And so you can see, for example, 48238 zip code has more than a 2% rent to price ratio,
Mhm.
which means it cash flows like crazy. Okay. Um, and then you got 227, 204, 208. And so these are the ones that we generally look at. We love 48238 because it's
Mhm.
always the best one.
Okay.
So we find the property, we put it in here, we get with Great Lakes. We say, hey, how much you think that you'll be able to rent this for? They'll tell us. We estimate a rehab based just on the information that we have. And over here, we can choose, no rehab. We can choose low rehab, and you'll see it's automatically generating the rehab cost in
Yeah.
$5,000 increments, and as well as the time. And then what it's going to do is going to tell us the maximum purchase price. Right. So if we got no rehab, maximum purchase price is around $42,000.
Mhm.
If we got a $10,000 rehab, it'd be about $32,000. What we're looking at is between rehab and purchase price, we're looking at around $45,000.
Yeah.
We put in what is the cap rate that we're trying to give that
Yeah.
investor,
Is the
right?
$8,000 just a buffer difference between 42 and 50,000, just a buffer for anything that might go wrong?
Well, yeah, because what it's doing is calculating. Um, yes, it's a built-in constraint.
Mhm.
It's built into the algorithms, but it can be overridden. So, for example, we say, "Hey, Mike, we got this thing. It's going to be about rehab of 10,000, but it's going to cost about 35,000." All right, still says deal. But what if it says it's 45,000? See how that changed to no deal?
Yep.
Put 40,000 in here, no deal. And
Right. So
so,
it's like it's got to be less than $50,000 for it to green light a deal. It sounds like is the condition.
nope, the condition is shown over here.
Mm.
Remember, we have minimum a preferred ROI of 10%.
Okay, I like that. Yeah.
So whether we are flipping it or whether we are holding it, both of these numbers have to be greater than 10%.
Gotcha. Okay.
All right. And then we've got very detailed um, calculations. We calculate everything,
Mhm.
full cost accounting, right? All right, here's the rehab cost. Here's the maximum purchase price that's determined by the system, but here's the current offer price. Is there a wholesaler fee? Are we going to use a mortgage against it?
Mhm.
Here are our other little costs, property inspection. We got to set up the LLC during escrow. There's no appraisal unless we're going through a formal loan processing, but we do use a company to determine what's called the AVM. That's the automated valuation method. It's like an electronic appraisal without going in the house and doing the appraisal. Title insurance, escrow and settlement costs, any miscellaneous fees. So for example, if we find this property through clearance, we got to give clearance $2,500. Okay.
Yeah.
So if Clarence negotiates the price for us and does everything like that, we pay him $2,500. If we do that and everything, we don't give him $2,500. We buy the property and then we say, here, you go and rehab it, and you're going to be the property manager.
Okay.
Okay. We charge our management fee, which is 2% of the purchase price, minimum $1,000. We got to have insurance on it while we're doing the rehab. We are generally responsible for property tax according to the time of year. So we help calculate that. And then there's holding costs. So while we are doing the rehab, we need to pay the insurance, and we need to set aside money in an impound account that goes to paying the property taxes.
Yeah.
And so we calculate the holding costs, how many months, that's the total investment. Okay. Try to keep it under 50,000, but we tell our investors need to have that extra $5,000 just in case. And then we say, okay, once it's done, what's the minimum price we need to sell this at, right? Mm-hmm. So we got to give the investor at least a 10% return. We're going to charge 4% if we sell it within our network. And then we usually have an agreement that whoever referred the investor gets an amount equal to 10% of the profit that the investor makes.
10% of the profit the investor makes.
Yes, it's called a residual referral program.
Gotcha. Interesting. So if I bought it for, so say I bought it for, I invested the 50,000, we'll keep the number simple, and it sells for 100,000, profits 50,000, they get 10% of that, or is it on top of that?
It's on top of that. So the way this works is this becomes a cost. Mm-hmm. And so we make sure that the profit is still 10% of the investment, including this cost. Mm-hmm. And so you see, we're adding up costs, right? This is all the costs to make the turnkey rental property, sales costs, profit cost, referral cost. Means we need to sell it for at least 62,000. Yeah. In this instance, again, what it does is it will calculate what price should we sell it at based on a 10% cap rate based on an annual net operating income. Right? So to find the value of an income producing house, you take the net operating income and you divide it by the cap rate. Right? So if we lower this cap rate from 10% to 9%, ooh, price just went up by $9,000. We have people in the Middle East coming into Detroit and spending millions of dollars buying up turnkey rental properties. They are accepting 7% cap rates.
Yeah, interesting.
That means this property would be $114,000 if we sold it to them.
One just technical question that I think you certainly can help me better understand. For cap rate, why is that used as a metric and not cash on cash return, or even like debt service ratio, like why does it make more sense to use cap rate? Because most of the time you are putting debt against something, and doesn't cap rate assume you don't do that?
No, so the cap rate doesn't care how you finance the purchase.
Right, right, yeah.
All the cap rate cares about is how much does the asset cost
Mhm.
and how much free cash does it generate per year.
Yep.
Now it allows you to compare apples to oranges,
Mhm.
right? So I got $50,000. Should I go put that into a 2-year bond that's paying out 4.5%? Or should I invest this in a turnkey rental property that's generating $7,500 a year?
Gotcha. Okay. Yeah.
You see what I'm saying?
You can at least compare it to other types of investments that you may be
Yes.
making. Got it.
Yeah. And because so when you're paying all cash, the cap rate and the cash on cash ROI are the same thing.
Yeah. It'll be very that
But when you're using leverage, the ROI is magnified
Mhm.
based on what your leverage ratio is.
Makes sense. Yeah.
Okay. You use a 5-to-1 leverage, your ROI is basically going to be 5 times the cap rate.
Mhm.
Okay. All right. So we then take this scenario and say, what if we have to hold it? And so that our final cost now becomes the quote unquote purchase price of holding it. We look at the monthly costs of insurance, property management fee, and the annual property tax on a monthly basis, and we come up with our monthly costs, right? These are our operating costs.
Mhm.
Compare that to the target rent, and we make $668 a month before putting any money into reserves. We put money into reserves for a vacancy rate as well as for maintenance and CapEx. These percentages may change based on the investor's risk tolerance.
Yeah.
Now, remember, we just rehabbed this property. Okay. We're looking to get a Section 8 tenant. We're
Mhm.
looking for a low vacancy rate, and we shouldn't have any maintenance issues for the first couple of years, and we shouldn't have any CapEx because all the CapEx stuff should have been taken care of during the rehab.
Right. Yeah.
Right. But risk management says you still put some money aside until you reach a certain level, and that level is dictated by the investor. We recommend that because we also say you should come in with some reserves. In this instance, we say 3 months worth. Okay, because things happen unexpectedly, and so we say you should at least keep putting money in your reserves until you have at least $1,000. Then we come up with this schedule for the next 30 years. Hey, if I was to keep it, what happens if I do an annual rent increase of 5% and the appreciation rate was only 3.8? Though we know in these zip codes, they've been double digit for the last 12 months. But again, we can change this, but we're conservative. And what's your marginal tax rate? And then what it does, it then calculates, hey, here's your ROI after taxes, depreciation, and financing costs, but before reserves. Here's your cap rate. And here's your annual schedule. Get $12,000 in rent, $4,000 in operating costs. You got $8,000 in net operating income. After you do reserves, you got $7,400,
Mhm.
right? And then it
Is that for year one? Is it, or what year is this modeled on? Is this like
yeah. So this is based on the first year. And so
okay?
that's why you can see here, we do a 30-year projection,
Okay.
right? This net operating income equals this net operating income. And then
Yeah.
year 2, if you had a 5% rent increase, right? And so forth. Okay. So we show this schedule. The main important thing is here, if you were just to keep the property, this is what you can expect to make just in that first year.
Yeah.
And then here's
What's the historical tendency for Section 8 stipend to increase? does that also increase 5%? If it's to Section 8 holders, their income would
Yeah.
also.
So here's the thing, Section 8 is usually behind on their rent increases compared to the market.
Mhm.
So these last few years, rent increases have been double digit, right?
Hmm.
And that started in 2021, right? So like in markets like Houston, they were over 20, the rent increase was over 20%.
Yeah.
I can tell you in Detroit, your typical rental property in the hood, 3 bedroom, 1 bath, 1,000 square foot. In 2021, we could have spent $25,000 to buy that house and to rehab it, put a Section 8 tenant in it, we would have got $500 a month.
Mhm.
That same property now is $50,000 and it rents $4,000 a month. Double the value, double the rent since 2021. Now, rent ain't gonna keep doubling every 3 years, right? But I can tell you, in 2022, October 2022, we were looking to buy our first property using this system. And the rent was $800 and the person was going to sell it for $40,000. And it had a tenant in it, a Section 8 tenant. So we were like, wow, that's, we're going to buy a turnkey rental and we're going to get that 2% and we don't have to do nothing to it. So they were in the process of doing their annual Section 8 inspection.
Yeah.
So we were waiting to get that information back. We wanted to see what type of repairs were needed. So they got that back. They had to do a couple $1,000s worth of repairs. We were like, okay, we'll do those and then we'll buy. Then out of the blue, they received an email from the housing commission that said, hey, we're going to increase your rent from 800 to 1,050.
Interesting.
Just out of the blue. They didn't ask for no rent increase. They just got a rent increase. And as soon as they get that rent increase, they canceled our deal and increased the amount to $50,000.
Yeah.
So it's unpredictable. Just know that they lag behind the market. So when the market's going up, they lag. When the market's coming down, they're also going to lag.
Mm-hmm.
Okay. And then we even have it for the retail investor. Because
5%, does that 5% feel reasonable to you then if it lags behind? Or how do you think about that 5% year-over-year increase?
It's trying to forecast the future
Yeah, it's
is really hard,
always a
especially when for things you don't have control
yeah.
over. Okay. And so, and this is why it's yellow, because we can change this, right? We can change this to 0.
Yep.
Right? We can change this to 1% or whatever number that you want to play around with.
Yeah.
Same with the appreciation rate.
Mm-hmm.
Right? This is just to give an idea of what happens if you were to hold it. Now, our strategy is don't hold a property more than 2 years.
Okay.
Get it to where it's well performing. And when it's well performing, now you can offer it at a lower cap rate because there's less risk associated. So as soon as you build it and you put a tenant in it, boom, you offer it to someone within our network at 10% because you're looking to get a quick sale and move on. If nobody buys it, then our next strategy is, okay, well, let's sell 90% of the equity and base it on a 9% cap rate. Well, when you do that, you're basically going to raise $75,000. So it's another way of getting 75,000. But now you've got these silent partners who came in based on a 9% cap rate, right? So on that 9% cap rate, property is worth, well, in this case, it's 89,000, but typically it's worth around 84, 85,000. Okay. So they buy in at that rate because we say we're going to hold it for 2 years, get it to where it's well performing. Then we're going to sell it at 7%. At 7%, everybody exit out, right? So your silent partners are getting around an 8.5% return per year. So on a $1,000 investment, they're getting $85 a year in year one, $85 in year two. But at a 7% cap rate, when you sell it, they get a 25% return at the end, and that's after profit split. And you just add them up. 80, 8.5 plus 25% is 43% over a 2-year period. As a silent partner, they didn't have to do nothing. Right? You, as the main investor, one, you're going to get your 30% profit by selling 90% of your equity, but you're going to retain 10% and you maintain control over the property. Right? So you're still along for the ride and you're along for the appreciation on the back end. So you're still going to make some more money. So I know I went through a lot of stuff.
No, this is helpful.
And this is pretty detailed because it's years of work.
Yeah, no, I honestly love and appreciate all the detail that's gone into this. Like, I've been building a little tiny model myself, but nowhere as in depth as this with your knowledge base. So, this is awesome. This is really interesting stuff.
I'm gonna show you one more thing though. Where is it? It's probably here. Nope.
How many doors do you currently have?
We got one. We're still on the first one, and we're selling of that property.
You cut out there.
In fact, I'll show you what that looks like. So this is the McKay property. Okay. We have a flyer. It's because the McKay property is owned by the McKay LLC. And we are selling 90% of it through an SEC registered crowdfunding offering on a FINRA approved crowdfunding website that is Black owned. It's called Secure Living. Okay. And this is the flyer that talks about it using the compliance statements. Right. And so when we go to the webpage, this is what it looks like. This is how much we've raised, 32,500 out of the 75,860. It's membership interest. Again, telling people to expect to be invested for about 2 years. Cash on cash return per year is 7 to 9%. Get cash paid out quarterly. And our exit strategy is to sell. I just went over that, right?
This is almost like a REIT, basically. Like, is this in
there you go. There you go. This is, you can call it a poor man's REIT. You can call it a poor man's syndication.
Okay, gotcha. Yeah.
Okay. Here are this document over here is the Form C. This is the most important document because this is the SEC approved document. Right? We had to put a lot of information on it. It is how many pages? This thing. It is 66 pages. Right? This is just short of what the information that you would have to provide if this was a public offering, an IPO. Okay. And so I ain't gonna go through it.
Yeah.
But
wow.
This is the table of contents. This is all the information that's it.
How long did it take to do this? I mean, just out of my own morbid curiosity, like, I find this stuff fascinating. So, like, how long did it take to go through this process? And was doing something like this, or?
So with me, and I had never done the Form C before, but remember, I got 30 years working for the mainly for the government,
Yeah.
doing doing administrative stuff, filling out forms like this, right? And we already had 95% of the information. So this took us about a week because I'd never done it. If I
Gotcha.
had to do it now, it would take a matter of hours.
Yeah.
Okay. So and here's the interesting thing. So this is for a crowdfunding offering, almost equal to an IPO. Okay. But if we were doing this through another exemption, like a Reg D 506B, and there's other exemptions where we're only targeting accredited investors, then we'd only do a Form D. And I've got to show you what a Form D looks like, because you're going to be like, huh? Okay. This is the Form D. The Form D is 18 pages. This is the information. Basic, industry group, issuer size, and you can put decline to disclose, which is crazy.
Wow.
That's an option. That's a valid option. List which exemption is a new or amended on filing. What type are you doing? Equity or debt? Minimum investment. Is there sales compensation? Are you using a registered investment agent, for example? These offerings are so simple, you don't have to actually use anyone to sell this.
Yeah. And so for McKay Street, you all had an initial a main investor. Now you're looking to, it's been however many months, it's been rehab, it's been flipped, and now you're looking to offer silent partners a 7 to 9% cap rate on the sale of this property. Is that a correct understanding?
It's 7 to 9% while we're holding the property.
Or holding the property. Gotcha. Yeah.
Okay. Then there's an added bonus when we sell.
Mm-hmm.
Just not included in here.
Gotcha.
Okay. So that's the exit strategy to our first client and to future clients. And here's the reason why. Well, first, let me show you. This is the file of the real estate deal management system for the McKay property.
Mm-hmm.
And these are the pictures. And this is the version that we would show to a retail investor, someone who just wants to buy it, is performing asset and wants a 7.6% cap rate. Sell it to you for $100,000. Okay.
Yeah.
And this is what, from the investor's perspective, buy it for 100,000. You use cash, or you can use a loan. He would take over our reserves, so probably wouldn't have to come in with any reserves. But he'd be looking at 7% annual ROI after depreciation, finances, and reserves. But he'd be looking at a 7.5% cap rate, and then again, all of these estimations, right? So I told you about investors from India who are very happy to come to Detroit and get a 7% cap rate.
Yeah.
There are also investors from California, from Nevada, from Washington, from New York, where they can't get 7% cap rates, right? And this property, again, is performing. We bought the property in March of 2023, entered into the contract with the Detroit Housing Commission as of November of 2023, and it's been going like clockwork.
Mm-hmm.
Okay. But here's what, oh, no, I want to do one more thing. Because I want to show you what the ultimate goal is. Because our ultimate goal is teaching people how to create generational wealth. Okay. So if you're able to invest $50,000 over a 6-month period, we produce a turnkey rental property that generates $1,000 in income, and we're going to be conservative and say the monthly cost of $375. And you saw it was actually less than that. But where the annual net operating income is $7,500. And now when we sell that, right, the gross profit is 25, you get 15,000 of that 25.
Yeah.
Boom. Here's what happens if you flip. So you can do 2 flips in the first year, right? It means you got a cumulative profit of 30,000. 30 plus your 50 means you end the year with $80,000. Well, with $80,000, you can still flip one house at a time. In year 2, what do? You go in, you start flipping. Just like in year 1, you make 30,000. So now you got 110,000. Well, now you got enough to start flipping 2 houses at a time. So now in year 3, you do 4 flips.
Yeah.
You end with 170. Now you can do 3 houses at a time. Year 4, you're doing 6 flips. You end up with 260,000. Now you can do 5 houses at a time. In year 5, you do 10 flips, 150,000. You end up with $410,000 off of your original 50,000.
Mm.
Do you see how that works?
Yeah, for year 1 though, this is assuming you only have $50,000 to invest to start.
Yep, you only invest $50,000 one time.
Gotcha. Oh, because of the deal time is 6 months. Got it. Okay.
Correct.
Got it. Okay.
So you grow your 50,000 to 410 in 5 years.
Yeah.
This grows exponentially.
Yeah.
Because the more cash that you have, the more houses you can do simultaneously.
Mhm.
You see that?
Yep.
13, 20. But in the end, for example, in 10 years, you'll have $4.1 million, but you will not own any houses.
Yeah.
You'll have cash
Mhm.
because this is just a flipping business.
Yeah.
Okay. Flipping business is lucrative, but you won't own any houses.
Mhm.
If you were to just rent the house and you just get $7,500 a year, it's going to take you 7 years before you have enough cash to be able to do another house. So at the end of year 10, you got 2 houses, but you only bring in $15,000 a year.
Sure.
This is the slow road to China. Okay. But when you're selling equity, this is how, again, in the first year, you're going to make this much profit off of selling your equity. And so you'll end up with 63. So you can do another house. In year 2, though, you're able to do, says 3 houses. Okay. Why does it say 3 houses? Oh, because you're able to do 2 houses per year.
Mhm.
And so you wind up with 91,000, but you'll have 3 houses,
Mhm.
right? That you own 10% of. And so this is a combination of these two. And so, for example, in year 5, you'll only have 268,000 in cash, but you will own 15 houses. And this is assuming that you keep all the houses and never ever sell.
Yeah.
Right? So this is like the worst case scenario. This is the minimum assumption. Because remember, we're recommending that you keep houses for 2 years, let them appreciate some more, sell, and you make more money. So this number is very, very conservative. But you look at the 10-year, you'll have $2.5 million, but you'll own 171 properties that are cash flowing, right? And your cash flow, you get $123,000 a year in cash flow.
Yeah.
So
And just from a supply standpoint, when you looked at the Detroit market and the zip codes that you really liked, I think you mentioned like 48, 23.8 as a top one.
Mhm.
Uh, how many houses do you see or have you seen, say, within a 1 month, 2 month period as fitting the criteria based on this model?
Well, so let me back up. So there are tens of thousands of houses that are available.
Mhm.
Probably 5% fit our criteria. We can throw them through our system, say deal or
Yeah.
no deal, right? But the, the ultimate goal is to put modular built homes on vacant lots.
Yeah.
And so that changes the dynamic.
Mhm.
And what we're talking about is we're talking about doing 1,000 units a quarter between single family and multifamily. Okay. That's 333 homes per month. Per
Mhm.
month.
Yeah.
At that point, because we're doing 4,000 homes a year, we will basically um, own or franchise our own factory that builds modular homes. And our price per unit will be under $50,000.
Mm.
We'll do either 3D printed homes, we can do container homes, we can do straight modular homes, whether we can do panelized homes. There's so many different options because of the technology out there, right? The first 150 homes will be the traditional way. That's to establish ourselves in Detroit, establish our name, and show that we are serious rehabbers, because that's what we'll basically be. We'll be a turnkey rental property,
Yeah.
but company. But now, then we turn into an actual developer, right? And we really bring California money.
Yeah. Do the modular homes come in multifamily or do they only come in
Yep,
single?
yep.
I gotcha.
Because you can
So,
stack them, you can configure them differently.
okay, gotcha. Is that something you'd be interested for investors as well, like to
Yeah,
offer that or
yeah.
only?
So my holding company, um, Temple Rose Holding Company, invests in and owns um operating companies.
Mhm.
Okay. So the BNIC Network is our main operating company. It's a series LLC out of Wyoming, so it has the ability to create subsidiary companies on the fly. We are creating a new type of legal entity called a closed private crowdfunding network, which allows like-minded people to practice cooperative group economics, aka crowdfunding, on steroids with little, if any, oversight by the SEC.
Mhm.
And the way that we are doing this is we are creating a network of investment clubs. And so I'll save that maybe for next week's
Yeah.
webinar, because we are a little bit over time of,
Um,
of,
yeah,
of
sorry.
what that looks like.
Mhm.
I'm sorry, Mr. Evans. I joined you late. I thought it was 6.
Oh, that's fine.
And,
Yeah,
I got
yeah.
you guys there was 5. I was ready at 5, but nobody. This has been quite interesting, I'll just have to make it to the next one's on time.
Yeah, and that
But my
was
question
my
to you,
fault. That was
so my
my
question
fault
to you,
because I had sent you the email saying 5. I mean saying 6,
uh,
and then I sent you a late email saying that it's 5. So I do definitely apologize for that.
yeah. So I didn't get the first part of the pitch, but you said there's like 3 different investment options. You can rent, you can own it, you can be in the flipper program, or you can invest in renting them out. Is that correct?
Yeah. So there are primarily 2 investment options. You can be the traditional investor that comes with $50,000 and buys a distressed property, rehabs it, turns it into a turnkey rental property. And at that time, he has a choice to keep it, earn a 15% cap rate, or to sell it or equity in the company that owns the LLC and basically flip it, right? And earn around a 30% cash on cash return over around a 6-month period. So that's the first investor. The second investor we call a retail investor. They just want to either buy the whole property or part of the property after it's already been built, after it already has a tenant in it, after it's already generating income, right? Put money in it, and then the next month they're getting some money out of it. So they don't have to deal with the headache or wait. Those are called retail investors. And they will typically earn between a 8.5 to 10% cap rate, according to if they buy the whole property or if they buy part of the property. Buy the whole property and you're in our network, we sell it to you at a 10% cap rate. If you're not in our network, we sell it to you at a 9% cap rate. If you come in as a limited partner, where you don't have no voting rights, you're just along for the ride, expect around an 8.5% cap rate, but now you get to invest, and we fractionalize the LLC. You can come in with as an investor with as little as $500. And you can earn money while we're holding it, and when we flip it at the end and sell it, you'll earn some money on the back end also.
And that's the one you said that's a long way to China, huh? Was that the
No,
Right, look
no.
at you.
So the long road to China is if you put in $50,000, you get a cap rate of 15%. So you're getting $7,500 a year, and that's all you do. That's all you do is you just hold on to it. You hold on to the whole thing, and you get your $7,500 a year. That's a long road to China, and I don't recommend that to anybody, because why do that when you can sell 90% of it, get your profit up front, and now let's go and buy another house while you still own 10% of this one, right?
Now, do the modular homes appreciate quicker than a regular built home from,
Oh,
you
way
know?
quicker. So they're cheaper, they are quicker, they have higher quality, they're in every category, they are better.
How about energy use? They need more energy because the
Yes.
walls are thinner, or
Yes, so that's what I'm saying. They're more energy efficient. They have a higher fire rating as far as trying to burn them down. Their rating as far as being able to withstand hurricane force winds is greater. Everything is greater, and you're going to get higher quality because they're built factory, right? And
yeah, you
so
should, yeah.
yeah, and so and it's shorter time and lower cost. And think about, for example, solar, right? When solar, the cost of solar energy 5 years ago was way up here. That cost now is lower than coal and gas because of
Wow.
technology and because of more people getting into the space. The same is with modular building. We're just at the very beginning. We're just at the very beginning.
That's great. So we have to own the property, because like you said, I'm out here on the West Coast. I really don't have time to fly back and forth to check on the property. Where I just want to come in and support the efforts instead of actually being an owner of the property.
Hey,
Which one is that, like a limited partnership, or
so here, so let me tell
that
you
again for me?
Let me tell you about our first client. Our first client, her name is Pam. Pam lives in LA. Pam has never owned an investment property. Pam has never visited Detroit. Pam hired us. We did everything for her. Now, she's involved in all major decision making, right? We do not control anybody's funds. Pam had 100% control of her funds. When we were doing the earnest money deposit, Pam had the money in her account. Pam transferred it directly to the escrow company to open up escrow. When she closed escrow, Pam transferred the money directly into escrow. When it came to the rehab and paying Great Lakes Property Management as the rehabber, we negotiated the terms, but Pam accepted the terms, and then she paid Great Lakes directly. We never touched any of Pam's account. Now we can see to Pam's account because we're the accountant,
Yeah.
right? But Pam never went to Detroit. She ain't never been to this date. She ain't never been. So it's according to what type of investor are you? Are you passive or are you active? I have a client in the UK who's looking to do 150 to 200,000. He wants to fly to Detroit in order to see it. He's an active investor. So you can be a passive investor and still be the traditional investor because we got videos, we got pictures of everything, right? Because our ultimate goal is to put all of this onto the blockchain. And on the blockchain, we'll issue NFTs to each owner. And an NFT is simply a verification of ownership. And in the NFT, you have everything that we've ever done with the property, from the time that we scoped it out to the time we bought it, rehabbed it, and have rented it, the financial statements, everything in a digital format, right? Because we want to make it easy for people, especially Black people, and the average Black person to come in and to make these 30% per per flip, 60% per year, and to be able to get, involved in that. I hope I answered your question.
Yes, you did. Thank you.
Okay. All right, either one of y'all have any more questions?
You opened up a whole nother can of worms with the blockchain, that'll have to wait. So
Hey, that's when we're gonna save that one. Look, so the next webinar, according to who comes, we'll focus a little bit about why Detroit. We'll focus on our process for doing turnkey rental properties, but then we'll spend the majority on our closed private crowdfunding network. Okay, and how the average person with as little as $120 will be able to get in on these type of deals.
Yep.
And then the webinar after that, we'll talk about how we're putting it on the blockchain and what's the purpose of doing it that way.
Gotcha. Well, thanks, Michael. I appreciate the time, and thank you as well, Sally.
Thank you, Mr. Evans. I'll be on the next one. I'm looking forward to supporting this operation. Seems like it's gonna bring a lot of needed housing to Detroit and build wealth. Otherwise, I'm real interested in it.
Absolutely wonderful. Thanks for coming. And Eric, thank you so much. And we hope to see you all next week. And I'm going to put up a photo. I'm going to put my picture up here somewhere, maybe about the next meeting or something like that, just so that you know who you're talking to, because sometimes my presentation isn't always on point. Hi, Mr. Simpson. So, because I just come from outside. Good. I just come from outside. I'll do the honors just on the first meet, but I'd rather have a picture. It still is, and but at any rate, we hope to not only, spark some, some questions and that you guys may have, but also, that there's something that, you see that is, something that you're looking to get into, because one of the things that we don't have, and Michael, I'm sorry, taking a little bit extra time, but to, this organization wants to do some great things with our people, for our people in Detroit and for us as a whole. And I just think it's a great opportunity to help build our neighborhoods. And if we're going to be some gentrification going over there, let's re-gentrify with us, and instead of letting other people do it, coming into our neighborhoods and fixing it up, we can do that ourselves. And, we can also benefit from doing that. So thanks, Mike.
Yeah, and you know what? I will put in the chat a link. Give me a quick moment. Let me grab it. But I'm gonna give you a link to Temple Rose holding company. Because our goal is to become the Black version of BlackRock. Okay, the largest asset manager in the world that manages about $9 trillion worth of assets under management. Okay. So this real estate is just one piece of a 1,000-piece puzzle. You will see I'm unapologetically pro-Black, right? You go to my LinkedIn, unapologetically pro-Black. I'm a Black nationalist and a Pan-Africanist. I'm also a MAGA fan. Make Africa great again.
Absolutely.
Did you put it in the chat yet? I didn't see it.
Yeah, no, I'll put it again because I think when you left and came back, you probably can't see it.
Okay, I see it now. All right, thank you.
Yeah. And so our ultimate goal is to produce Black-owned and controlled private gated master plan communities here in the United States for those who want to remain in the United States. For the rest of us, we going to Africa, right? We going back to the motherland, the continent that has the most natural resources in the world. The continent that is currently being exploited by not only the Western colonizers, but now China. Okay. We as African Americans, we are the tip of the spear when it comes to the African diaspora, which is almost 2 billion people worldwide. There's only about 50 million of us as African Americans, but we have more than $1.5 trillion of spending money per year, and less than 2% of it is spent on Black companies. And we probably have about $1 trillion worth of wealth, right? And what we know is come November, whether Trump wins or loses, his MAGA fans are going to act a fool.
Oh yeah,
and so,
absolutely.
That's, we know everybody ain't going to want to move to Africa. So for those who want to stay, we want to build those private gated master plan communities that are self-sufficient and that can protect themselves, right? We as African Americans have a history of producing wealthy communities multiple times since the end of slavery, that poor white folks get convinced by rich white folks that, hey, y'all better than those Negroes over there, go burn their stuff down. Okay. That's not going to happen with the communities we build. Ain't nobody burning down nothing, right? So we learned from the past. We understand what the government is capable of through the COINTEL program. And so we act accordingly. It's time to play chess, stop playing checkers. We need to stay 6 or 7 steps ahead, and we need to have the proper counter measurements for when they come at us. Not if, but when.
When.
I will step off my soapbox now.
Okay.
So everybody have a good evening, and Eric, we can talk offline also about how you can get involved, because there's multiple ways of how to get involved, man. Because there's a lot of stuff that we're doing. This is just one piece.
Yeah, I know help is always welcome, I'm sure. So I'm happy to see where I can step in, plug in. So we'll chat soon.
All right,
Wonderful.
everybody.
Thank you so much.
Everybody have a blessed night.
Bye-bye.
All right, you too.
Bye-bye.
Bye.
And let me see. I guess I can take control back. Oh, maybe not. All right.
Uh-oh, do I need to give it back to you?
Yeah. Yep.
No, I don't know how to do
Thanks
that.
for your time. I'll see you guys
Thank you,
next
sir.
week.
All right.
Thank you. Bye-bye.
Hi. Hmm.
You know what? Let me see.
The
Yeah, because
security
usually
setting
there's
over here.
a way where I can get control back. But you know what? Don't worry about it. We're at the end, so just leave and the recording will automatically stop.
Okay, it'll stop on its own. Okay, I see record. I can just push that little button
No,
and that'll stop it.
You only have to do that. Just
Okay.
hit
Just
leave the
leave.
meeting, and I'll
Okay.
see you next week.